Morning everyone. This is the DAX 1 minute chart and this is the price action up to just after 8:45 this morning. And so it's Friday the 11th of May, and last Friday we had a cup and handle breakout formation appear in early trading on the DAX. And we got the same again this morning, another cup and handle formation and a breakout from that cup and handle. And so I'm going to talk you through this particular chart pattern, and I'm going to talk you through the rationale that I had for establishing which direction this cup and handle formation was going to break out from. And so I'm going to talk about the banks, the institutions, how they manipulate, if you like, the price action, how they place their orders and build positions, and how you can read what they're doing from the price action. So first of all, then the pre-market on the DAX opens at 7 o'clock, and this is the 7 o'clock bar, big bear bar there, and the market comes down. So this is 8 o'clock, and so we've had a downtrend leg in the early part of the trading this morning in the pre-market. And so the market opens at 8 o'clock, and it opens at 8 o'clock, and you get a big bullish bar here. Now, the market's in a downtrend leg, but that doesn't mean that much in terms of what we might expect from price action in the early trading in the DAX, because as we've established in previous videos, the market tends to react to highs, pre-market highs and pre-market lows. So the pre-market high being up here, pre-market low down here, establishes a range normally in the early trading which will encompass and be within this high and low that's established in the pre-market. And you can see that that happened today, and all of this price action is taking place at the bottom of the pre-market range. Now, quite often I look for trades from the bottom of the range up to the top of the range, and from the top of the range down to the bottom of the range. And that wasn't likely to occur this morning, and one of the reasons for that was because if we just quickly have a look at the 30-minute chart. This is the 30-minute chart, and you can see this is the 7 o'clock to 7:30 candlestick bar, and this is the pre-market action, 7 o'clock, 7:30 and 8 o'clock. And what you can see from this is that the market was in an uptrend leg, and all the trend lines from that particular trend leg have been broken by this big bear bar here. So the market's broken out below these lows here. It's now trading below the 20 EMA, it's trading below the 8 EMA, and it's paused. It's gone up, and it's rejected down off the EMAs. And when you see this, you've got to think that the likely outcome is that the market's going to go down somewhat. Now, the overall market's been in an uptrend for a long time, and therefore you wouldn't necessarily, on the 30-minute chart, you wouldn't necessarily want to take a trade short based on the 30-minute price action. And the reason for that is because the chances are that prices are going to come down here and then they're going to bounce up again. And so there's no good risk and reward from the 30-minute chart in terms of trading short. But that doesn't mean that on the 1 minute chart that you're not going to get some price action where you can take advantage of a good risk and reward trade with good probability going short, which is what we occurred. It was only a small move, this breakout here, but it was a 2-to-1 reward to risk trade. And once you're in a position with your trading where you're skilled enough to be able to get 2 times your risk as a reward, then that's how you're going to build a small account, and you're going to build it quite rapidly as well, as long as you start using compounding. So coming into the open at 8 o'clock, you know, because you've looked at the 30-minute chart, you know that the market's broken out lower, and then it starts pausing effectively on the 30-minute chart. So what you're looking for is evidence that the market's going to go down. And of course, it's never as simple as, or very rarely as simple as, you get a breakout and it goes down straight away. Almost never as simple as that. Because one of the reasons is the banks, the institutions, the hedge funds with the big money, they're building positions. They tend to be building positions. If the market's going to go down, then they want to accumulate sell orders. And they can only do that if people are buying. So they create a climate that the less experienced traders may believe that the market is going to go up, so they start buying. And the less experienced traders, they start buying. Maybe some of the smaller institutions, some of the other institutions start buying with the expectation down here that the market's going to go up and go up to the top of this pre-market range. And this is manipulated price action, and it happens all the time, especially on this particular market. And so what happens then when people are placing buy orders? They're placing buy orders, and they have to have some level at which they know they're wrong, and they place their stop orders, their protective stop orders, at that level or just below that level. So they'll be placing their stop orders down here. Anybody going long places the stop orders down here because this is the low of the pre-market range. And market goes up, two big bull bars in here give people confidence that the market's going to go up here, and they're going to profit from going long. Market comes back down and it makes a slightly higher low. So you've got a lower low, a slightly higher low. You're talking about 0.2 points here, but all of these, every single minute little part of a point can be significant in trading. And then the market goes up and it makes a lower high. So you've got a higher high and a lower high. And then the market goes down again, and we can, at this stage, we can start thinking about levels. And so we can put a level in here, and this is the cup, if you like, you can see forming here. This is the cup, and this is the handle forming here, cup and handle formation. And so the market comes down, and of course you've got computers buying at this particular level. And what is significant, and it's minute detail, but it is significant, is that this level here, this low here, is slightly higher than this low here. You're talking about 0.2 points, but this low here was 0.2 points below this low here, and it's an identical low to this low here. And then the market goes up and it makes a high, and this high here is absolutely identical to this high here. And it's easy to miss these sort of things, but because it's identical, it tells you something, and it tells you that there are big sell orders coming in. You've got 1, 2, 3 bull bars, nice continuation from the low here, and lots of people will have been going long, expecting the market to go up and break out higher, close the gap to the high of this pre-market range. And it didn't happen because lots of sell orders came in here, and again, all of the people who went long here placed their protective stop below the lows here. And so the banks, the institutions, the big money knows that if they can force price back down, that there are lots of orders to sell their buy positions at this area here. So it almost becomes inevitable that when prices go below these lows, that you're going to get some sort of breakout and a reasonable trade out of it. And so the market's being forced down, and it produces a little pause here. This is where I got in. I got in at the close of this bar here, expecting the breakout lower, anticipating the breakout lower. Market went up, and this rejection here is important because it means that buyers who came in here expecting the market to go up again, maybe expecting even to take profits here, they were trapped in their long trades in this spike here. You got a very small pause bar following that. When you get pause bars at the bottom of a trading range, you often find that when the market isn't going to break out, that you get a big reaction and traders buy. They tend to buy small bars at the bottom of trading ranges and they sell small bars at the top of trading ranges. So when this bar was followed by a bear start to this candlestick here, you know that prices are going down at this particular stage. It becomes almost inevitable. And so my initial risk on the trade, entering here, my initial risk was actually up here. I put my protective stop up here just in case the market went back up and then came down. But I'd already decided at this stage that I thought the market was going down. And I brought my protective stop down as soon as this barrier here was broken. I brought my protective stop down to above the high of the bull candle here, the bull spike. You're looking for 2-to-1 reward to risk with your entry here, your stop up here, then you get a 2-to-1 reward to risk trade, and the exit, I think I exited at the bottom of this bar here. So nice quick trade, only took about 5 minutes. That's how I analyze the price action. And for anybody who's interested in looking at line charts, it provides a clearer picture of this. You've got your downtrend, you've got a pullback. It's in this particular context, this is a lower high, higher high, lower high, and then the market starts making lower lows. So you've got this low here, lower high, lower low, lower high, and then the market breaks out. So it's not rocket science. Trading is quite complicated. You need to know what you're looking for. That's why you need a good education in trading. I coach traders, I train traders. If you're interested in learning to trade, if you're interested in advancing your skills in trading, I'll be pleased to help. But I hope you found this video useful, hope you found it interesting. And this was a cup and handle breakout short, nice quick trade, early morning, and done for the day on this particular occasion. My name's Anthony Beardsley. Thanks for watching. I'll catch you on the next one. Bye for now.